Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. This month I'd like to update you on our thinking regarding the mispricing of risk and how, as a consequence, we have a potential global systemic market exposure. We are presently beginning to see the early signs of the repricing of risk, which may trigger the unintended systemic consequence of risk having been intentionally mispriced for close to 9 years now. As such, I would therefore like to cover the following subjects shown here. We started warning of the huge problems we saw with volatility as measured by the VIX as part of our October LONGWave video entitled Powering the ETF Dynamo. To us, the once cottage industry of shorting the VIX was becoming so pronounced and pervasive that we felt any short squeeze would be extremely disruptive to the stock market and possibly trigger contagion effects. Our analysis indicated it had the strong potential to lead to problems in the credit markets and most visibly in the junk bond markets, who in turn could disrupt the over-leveraged, or I should say highly over-leveraged financial markets. This cascading impact wouldn't happen overnight, but would likely be a steady, progressive breakdown, like a dam with enlarging cracks appearing, before rupturing into something globally systemic in scope. We feel this is exactly what is underway now, even though the markets on the surface may have calmed down since February the 5th. On February 6th, the day after what we labeled Black Monday 2, we initiated an almost daily MATA SII mailer on what we perceived was unfolding and how it would likely progress going forward. The stages had a lot of new acronyms that we discovered few had heard of or were familiar with. We have discovered that in every crisis event, which we have witnessed since 1987, a new list of acronyms emerge which are at the root of the new financial crisis. In every instance, the public had never heard of these acronyms, since they had been kept from the public eye as too technical for the unsophisticated. Meanwhile, they had grown quietly, like a malignant, undetected, deadly cancer. It always turned out, however, that those who paid the biggest price were in fact the unsophisticated, or more specifically, the unsuspecting. I drew this illustration not long after the financial crisis, as we are witnessing the emerging approach the Federal Reserve was taking to the resolution of the 2008 crisis. The last update of the diagram was in 2012. Note 2002 copyright at the bottom, as quantitative easing 1 was initially rolled out. The graphic has stood us in good stead in recognizing what was to be expected going forward. The Federal Reserve had effectively papered over the problem during the crisis by initial policies of kicking the can down the road. As a consequence, this subsequently led to other policies which we concluded could not be described in any other terms but monetary malpractice. As a direct consequence of the moral hazard and unintended consequences of these policies, the increasingly dysfunctional markets delivered new phenomena, which we were fully expecting to emerge as a consequence. We weren't sure what imaginative new financial engineered approaches the Wall Street money mavens would concoct, only that we could be assured that it would happen behind the curtain. What has emerged is a dangerous self-reflexive feedback loop, which exists between the central bank stimulus, sustained ultra-low interest rates, false data signaling, asset volatility, and financial engineering, which is both mispricing and allocating risk based on that volatility. This is leading to what more and more analysts are recognizing as a self-reflexive feedback loop, where lower vol feeds into lower vol, and vol meaning, and you'll hear me say this continuously, is an abbreviation for volatility that now has become the operative word, and has resulted in vol across asset classes being at multi-generational lows. The short vol trade has become a dominant strategy for a very large segment of market participants. Short vol is now effectively an investment asset class estimated to be over $2 trillion globally, encompassing various financial engineered equity product strategies. Unfortunately, this loop, as so many loops do, can reverse and is likely to reverse violently. A number of unexpected market shocks, such as higher inflation, can abruptly trigger this event. The higher vol that would occur would then in turn reinforce higher vol. This new asset class is now a massive misunderstood risk in today's market environment, which is not being correctly priced in. The distortions all began with central bank stimulus, which itself is only one element of the macroprudential strategy of financial repression, aggressively pursued since the mid-1990s, whereby the public more recently has been forced to accept increasing levels of financial risk as the natural rate for bond yields is artificially suppressed by policies of quantitative easing, ZIRP, and Operation Twist. The moral hazard which has emerged is the mistaken belief that the central banks will always be there and have no choice but to support markets. Investment strategies peddled to insurance companies, pension plans, endowments, family offices, etc., have been built on this foundation. Suppressing volatility, which we will explain how it is occurring in a moment, does not mean risk has vanished. Rather, it means that risk is increasing as accurate information on systemic risk is being suppressed. The global financial system, as a consequence, is becoming increasingly fragile and thus more prone to collapse. And an artificially low measure of volatility assisted by the Federal Reserve doesn't change this simple reality. In fact, newly appointed Fed Chairman Jerome Powell surprised many during recently released 2012 FOMC minutes, as well as his February Humphrey Hawkins testimony, when he referred to the Fed reducing its short vol positions. What is the Federal Reserve doing holding short vol positions, other than it being just another financial repression policy to manipulate markets? Though central bankers' policy has been the creator of the distortions which has fostered this self-reflexive cycle, don't doubt for a moment that it will sacrifice the equity markets and reverse its position in a heartbeat if the debt markets are in trouble. This is a mounting concern today as the debt supercycle completes its final stage, with interest rates having reached their lowest levels in recorded human civilization and $10 trillion in bonds trading at negative yields. The central bank policies of quantitative easing brought demand forward, but maybe more damaging, unleashed the global supply chain to unprecedented levels of overcapacity and fostered reduced pricing power. Additionally, excess liquidity and easy abundant credit has led to excess investment capital, resulting in overpriced asset acquisitions. As a result, corporations have found that it's not very efficient to reinvest in human capital, or CapEx. That stands for capital investment expense. Instead, they are literally eating themselves as they buy back their shares. Corporations for the past 6 to 7 years have been levering their balance sheets by taking on cheap debt to buy back shares and pay out shareholder dividends. It is estimated that 1/3 of gains, or about 30% of the share price gains since 2009, have come from the share buyback phenomena. We would already be in an earnings recession if it was not for share buybacks and the mistaken indicator signal of PE growth based on earnings per share outstanding. The fatal flaw this distortion has created is a price-insensitive buyer that is always there to buy back the market. This floor has removed perceived risk and destroyed realized volatility. In effect, the stock market is cannibalizing itself quite literally, and this is having a pronounced effect on lowering vol. But one of the things we've been seeing is that every single time volatility jumps, it mean reverts immediately. We've had some of the most mean reverting markets in history. That actually is quite unusual because volatility tends to cluster. This has been driven by some of the effects of share buybacks. So beyond the blatant overvaluation of the market and the fact that price multiples are driven by buybacks, price earnings ratio is still something that people put out there and say, oh, the stocks are not that expensive on a price earnings ratio or PE growth ratio. But if you look at market capitalization to GDP, enterprise value, EBITDA ratio, price to sales ratio, and other ratios, a lot are affected by the buyback phenomenon or funnel through like enterprise value or EBITDA ratios. We are seeing across all these multiples some of the highest overvaluations since 1928, 2007, and the late 90s. So really, the buyback phenomenon leads to a situation of a greater fool where the markets keep going up and up and up, quashing volatility. If we end up seeing a collapse in buybacks, either due to rising interest rates, which would make it unprofitable for companies to continue to do this phenomena, if we see the situation where there is some shock to the system and or credit ratings of companies begin to come into peril as a result of rising interest rates and are not willing to issue shares to buy back their debt, then the buyback dynamic may perilously stall. But there is more going on than the mere size and reasons for corporate stock buybacks. It is actually, in my mind at least, about the diminishing size of the tradable float pool on major index stocks. For example, over the last few years, there has been diminishing numbers of secondary offerings by corporations into major indexes, as well as an almost complete disappearance of IPOs, adding to the overall available stock pool. IPOs in the U.S. since the hideous Sarbanes-Oxley legislation appear to have become a quaint perturbation of the dot-com era. Even more staggering is the size and scope of private equity stock ownership, making their purchased stock unavailable for public trading and further adding to the distortions driving the emergence of reactive strategies. For few appreciate that the top 4 U.S. domiciled private equity firms are now managing close to $1 trillion in assets, and the industry overall will approach $6.4 trillion within 2 years. I'm told by fairly reliable sources that private equity now actually controls the stock of over half of all companies listed in the S&P 500 index. We will come back to the subject of share buybacks in a moment when we discuss the implicit short volatility trade. First, however, let's consider the scope of the explicit short vol trade itself. I personally don't believe the public understands the risk in today's market because, for starters, they don't understand the financial mechanics of risk, and certainly risk as an integral part of the financial markets and how it is priced in. As most are aware, there is a big difference between price and value. Often, and more so today than ever, that difference is the element of misunderstood risk. Risk can and is often cleverly hidden. However, never forget, financial risk cannot be destroyed. It can only be transferred. Traditionally, around the globe, risk is priced against what has long been considered the benchmark for risk-free investment, that is, the 10-year U.S. Treasury note. The held belief is that the U.S. Treasury would never default on its debt obligations, and as the world's reserve currency could always print whatever it needed to meet its debt payment obligation. This widely held belief stems from the pre-1971 era of gold backing the U.S. dollar. In today's fiat-based currency regimes, the risk in the risk-free 10-year U.S. Treasury is currency devaluation risk. But the risk is even much greater than currency risk. Central bank policies of quantitative easing are actually about creating that currency, which is used to buy U.S. Treasuries in the open market. Such policies drive down yield from the natural rate, or should we say the unmanipulated rate, to a lower rate depending on the artificial buying pressure created by the central banks. These rates, until very recently, were at historically low levels. The difference between a natural and the trading rate is risk. Risk that the central banks might stop buying and bond yields would return, possibly and likely, to its natural rate. This is precisely what the federal banks are now doing with taper and normalization policies that they have announced and are undertaking. As bond yields are now rising, their price is falling. Holders of U.S. Treasuries are taking a major financial pounding, and it's going to get worse, by the way, I believe, as the bond bubble begins to deflate. Never for a moment forget that bond values underpin a huge amount of collateralized loans, who in turn underpin global financial leverage. Additionally and separately, asset prices are traditionally connected to bonds through the relative value of stock dividends and bond yields. Money flows where it is treated best once the premia for relative risk is factored in. That risk premia is based on volatility, where volatility in turn is used to price options value, which in turn is used to hedge. Beginning to see the potential flaw? Everything is connected, but unfortunately manipulated by the distortion in and mispricing of risk, along with a startling lack of price discovery. Today, the price of stocks is less and less a matter of their fundamentals, but rather their volatility or lack of volatility. Example after example shows the extreme correlations that are occurring. Whether stocks or bonds, volatility has become the cornerstone of asset pricing. Both are connected by rapidly evolving opportunity reaction strategies of the market. All these relatively recent strategies spring from the unintended consequences and moral hazards, as I've said earlier, of the central bank policies. This has led to the outperformance of short volatility trades, passive funds and indexation, and various strategies that use financial engineering in some way to bet on market stability, introducing a kind of short gamma effect in the market. These could be strategies ranging from everything from risk parity to vol rebalancing funds. This is all great as long as volatility is low or dropping, as long as markets are stable. But in the event that we have a reversal in this, there's $2 trillion of equity exposure that self-reflexive driving lower vol can reverse in a quite violent way. If you look at short volatility and you think about what volatility really is, it's a bet on stability. And when you're betting on stability, that's a myriad of different bets. Part of that is the expectation that markets remain low with low volatility or low realized volatility. Part of that is short gamma. So there is this implicit short gamma exposure. Part of that is a bet that correlations remain stable, or that different market relationships remain anti-correlated with one another, or that implied correlations are dropping, or interest rates remain low or go lower. So if we look at each of these different factors, these are the risk exposures that you will have when you own a portfolio of short options. And if you own a portfolio of short options, you are short vega, gamma, correlation, and interest rates, those familiar with those terms. What we see now with this short vol trade explicitly and implicitly is that various financial engineering strategies out there have become dominant in the marketplace. We're talking about the largest hedge funds in the world employing these strategies that are just replicating the exposure of a short options portfolio. And of course, the VIX trade gets a lot of attention, but it's the smallest portion of the short vol trade. This is what is called explicitly shorting volatility. This is where you're literally going out and you're shorting an option or you're shorting a volatility future. But in the VIX space, that's only about 5 billion worth of short exposure. You have about 8 billion of vol selling funds, according to Bloomberg at least, and then about 45 billion estimated in pension overwriting strategies, these short port or short call strategies the pensions are doing. So in total, there's about maybe 60 billion of explicit short volatility, which is big, but that's not the most concerning aspect. The bigger aspect is this 1.4 trillion in implicit short volatility strategies. These are replacing the exposure of portfolio short options, even though they may not be directly selling derivatives or directly selling optionality. These reactive strategies have been profiting from and supporting low vol at the top, moving to even lower vol at the bottom, that's shown in this chart. The game of shorting volatility is so large that insurance and pension plans have been spiking their returns recently by employing various strategies shown here. I read a while ago about a guy quitting Walmart to short the VIX and made $4 million from next to nothing in seed capital. When interviewed, he knew nothing about volatility except this strategy just kept on working. And I think that defines what's going on here. For example, we have about 600 billion worth of risk parity funds out there. Risk parity is a strategy that shorts gamma and shorts correlation. We have about 400 billion of vol controlled funds out there. That's a short gamma strategy. about 250 billion of risk premium strategies. And then there's the equity exposure to CTAs, our commodity trading advisors who do manage futures. So these are strategies that have elements of short volatility trade embedded into their equity exposure. This chart breaks these strategies into two groups along with share buybacks as a separate third reactive strategy. You can see how large some of them are. The top of the pyramid are explicit short vol strategies. The middle tier are the implicit short vol strategies, and the third tier being share buybacks, which are effectively putting, as we discussed earlier, a floor under the market, and by doing this are reducing vol. What is happening is that each layer is feeding off the preceding lower tier. At the bottom of the short volatility trade is this 3.8 trillion worth of share buybacks that has occurred since 2009. One might look at share buybacks and say, wait a minute, this is not a financial engineering strategy. That's not a short vol strategy. But let's think about what share buybacks do. If you're a corporate CEO, you don't have the ability to generate growth. You can't create sales right now, or recently in the last decade, and you want to get your bonus. So you can't generate earnings if you can't help your top line. What you can do is reduce the number of shares, and this artificially increases earnings per share so you can hit your bonus target. You go out and you issue debt and you buy back your shares. You're leveraging the company up, which means that you're exposed to interest rates, you're exposed to market stability, and then you're buying back your shares, resulting in a price-insensitive buyer that is always underneath the market, resulting in this price-insensitive buyer always buying on the market dips. So the result of this is that you're artificially reducing realized volatility. The strategy is always to buy on the dips. This is part of the replication strategy of short variance swap. Literally, it's part of the replication of shorting vol. When you add all this exposure together, we have this self-reflexive short straddle of financially engineered strategies in the market, and this really comes out to about 2 trillion worth of implicit and explicit short volatility strategies. And then you can tack on the share buybacks, resulting in this. In 1987, portfolio insurance comprised about 2% of the market, leading to Black Monday, and that was a reflexive strategy. Today, anywhere between 6 to 10% of the market is comprised of these self-reflexive implicit and explicit short vol strategies, and this should be concerning. I said this cycle will reverse with potentially massive ramifications. Central banks have reversed policy. Buybacks are running out of leverage. I think the distortions associated with passive index funds is going to be the big bang. As you recall, alpha and beta gains are all relative to indexes. These ETFs are all buying and feeding various indexes. When they hit the sell button, watch liquidity disappear in the night. My experience with market crashes going back to 1987 is that in all major market crashes, the biggest problem and shock is the sudden, rapid, and unexpected disappearance of liquidity. This liquidity is going to be about no buyers. The big reversal is when the big pain comes. I expect it isn't too far in the future and likely to occur with the next U.S. recession. A recession considered presently long in the future, but this perception isn't warranted by the facts. Least of all, we are already into one of the longest cycles ever, and now that cycle is showing signs of fatigue and peaking. So, who is holding the hot potato in all this? As we stated earlier, suppressing volatility does not mean risk had vanished. Rather, it means that risk is increasing as accurate information on systemic risk is being suppressed. The global financial system is becoming increasingly fragile and thus more prone to collapse. An artificial low measure of volatility doesn't change this reality. There will be few places to hide in an over-leveraged financial system when this reversal occurs. Sometimes it's better to simply not participate and just sit on the sidelines. I'm always reminded that 1, investing is about having a high probability of success with excellent risk-reward factors. But 2, speculating is about poor probability of success and a bad risk-reward ratio, but the speculator relies on something he knows or he believes others don't know or simply has a hunch. And 3, gambling is about the odds being completely against you and having unacceptable risk reward, but you simply feel lucky. Do you feel lucky? Maybe you should ask yourself whether you are investing today or only speculating or possibly just out and out gambling. If you don't know the true risk, it certainly can't be called investing now, can it? As I often do, remember, they'll print the money to solve any and all problems until such time as no one will take the money, or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react or will be forced to react. Your chances of success go up dramatically. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. Thank you for listening.